In this week's video, we'll be examining a very simple question. Do the charts support the bearish hype? After reviewing the facts and hard data, you can draw your own conclusions. As we review the charts that follow, let's do so in this analytical context. Technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. In a short takes post dated March 5th, 2018, we noted the million-dollar question facing us today is as follows. Does the present day look like a correction within the context of an ongoing bull market or the early stages of a new bear market? Why is the answer to that question so important, at least from a probability perspective? If this turns out to be a correction within the context of an ongoing bull market, it means by definition that higher highs are coming in the S&P 500. If higher highs are coming, then it's prudent to be patient, because if we get a higher high here, our profits will be higher than they were back here. Conversely, if the probabilities say it looks like the early stages of a new bear market, it says lower lows are coming. And if a series of lower lows are on the way, then it would no longer be prudent to be patient with our positions. To help us answer that question, we'll use a set of generic moving averages for illustrative purposes only. We'll start with the 50-day moving average in blue, and we'll go all the way out to the 200-day moving average here in pink. Even if we don't know anything about technical analysis, math, moving averages, or stocks, we all understand the concept of pattern recognition. If we were taking a multiple choice test and we had to identify the two charts in this set of three charts that looked the most similar, assuming this was A, this was B, and this was C, the answer is relatively simple. It would be B and C. So right off the bat, by putting the dates back on the pages, and we're looking at the exact same moving averages, and each one of these charts represents roughly an 8-month period. The two charts that we identified as being the most similar before we put the bias-inducing dates on the page were March 8th, 2018, or basically the present day, and April 1st, 1996. The third chart that looks significantly different from the other two is November 19th, 2007. These dates here were picked for a reason. November 19th, 2007 is 41 calendar days after the major bull market peak that occurred in October of 2007. On March 8th, 2018, the day this video is being recorded, we are also 41 calendar days from the peak that occurred in late January of 2018. So we're comparing apples to apples. If you know your market history, you know this is a terrible time to stay fully invested in stocks going forward. And you know this is a very advantageous period to be invested in stocks going forward. Let's dig a little deeper and see what we can learn. Moving averages work just like price. When they're making higher highs, that's meaningful, and when they're making lower lows, that's meaningful. The first thing that jumps off the page, the 50-day moving average in blue, makes a discernible lower high 41 calendar days after the S&P 500 peaks. The market peaks here, and our moving averages, for the most part, all are making a lower high relative to these highs out here, especially the fastest, or the 50-day. This is discernibly lower. That's in stark contrast to 41 calendar days after the present day peak. If we go back the same amount of time, instead of being quite a bit higher here, the 50-day is quite a bit lower. This looks like the early stages of a potential downtrend. This looks like a healthy bullish trend. In April 1st, 1996, from this perspective, unequivocally looks a lot more like March 8th, 2018, and April 1st, 1996 really doesn't look anything like this period here. This looks like a sustainable and healthy bullish trend. This looks like a sustainable and healthy bullish trend. This looks like a bullish trend that's waning. The Coke machine is rocking back and forth. And since we know bullish trends make a series of higher highs and higher lows, and bearish trends make a series of lower lows and lower highs, eventually we have to go sideways to go from this look to this look to this look. What happens if we draw a horizontal line here in the fastest moving average? How far back can we go and still hit that same moving average? The answer is 4.5 months. So even before the S&P 500 peaks, we get this sideways type consolidation look that's telling us to pay closer attention. This is telling us we have a higher probability of rolling over here. The purple line touches the blue. We go across, it's still touching the blue roughly 4.5 months later. If we try to draw similar lines in March of 2018 and April 1st, 1996, we can only draw a line that goes back a few days. If we keep extending this line out this way, it's never going to hit the fastest moving average. This sideways movement is higher risk. You better pay closer attention, which is quite a bit different than these high conviction looks that we have in 2018 and also in 1996. If you study charts long enough and look at the details, markets typically start waving yellow flags before bad things happen. In July of 2007, which is 1, 2, 3 full months before the S&P 500 peaks, our moving averages start to roll over here in a bearish manner. This looks discernibly different than this period here, and all of this back here. This isn't a major red flag. These are yellow, pay closer attention flags. If we come down to the same point before the peak, so I can see this well before the S&P 500 peaks. If I go back the same amount of time roughly, I don't have anything like that. This is a much stronger trend. This is higher bullish conviction. The slope of these lines tells us the market's net aggregate opinion. That's all of the bullish opinions plus all of the bearish opinions equals the net aggregate opinion. This tells us that bullish conviction on multiple time frames, from the 50-day all the way out to the 200-day, is clearly favoring bullish outcomes. That's not the case here. This is a very indecisive. The bears are starting to gain traction in here relative to the bulls. The bears are much healthier in here than they were back here. Once again, 1996 looks a lot like the present day. And 1996 and 2018 really don't look anything like the period before the S&P 500 peaked in 2007. Similar situation here with a similar message. Before the S&P 500 peaks, our fastest moving average moves from the top of the cluster almost to the bottom of the cluster. This is evidence, once again, of a waning bullish trend. Higher risk, higher indecisiveness, higher probability of rolling over, higher probability of knocking the Coke machine over. We don't have anything like that down here. Blue starts to fall here, goes into the cluster. Blue is on top the entire time, during the entire correction that we've just experienced. Similar situation down here. Blue, for the most part, stays on top and never gets down into this area here. Blue never gets into this area here, and it does here. These are not major red flags. These are yellow flags, and this is telling us that the math is more vulnerable to rolling over, and thus the market is more vulnerable to rolling over. You're not predicting here. You're just saying the probabilities are now a lot closer to 50-50 and mixed in the short run than they are back here looking at just these inputs. Another thing that jumps off the page, we have a tight cluster of moving averages. We know when moving averages cluster, it tells us that a big move could be coming. We're not sure if it's up or down. We get a clue here, though. This is a tight cluster here, and this is a lower high relative to this high. Still wouldn't guess here but we'd be much more open to a break to the downside. So 41 calendar days after the stock market peaked, we had evidence that told us to pay closer attention and/or you should start cutting risk in here. 41 days after the peak in the present day, we have what looks like a bullish and sustainable trend in math that does not look particularly vulnerable to rolling over into a protracted and multiple month or multiple year bear market. This looks a lot more like this and really doesn't look anything like this period in here. Obviously, it would be helpful to know what happened next from this point here and this point here, knowing that the present day looks a lot more like this point here. The answer is, after we could see all of this and measure it, the S&P 500 lost an additional 53%. And from here, which looks much more similar to the present day, the S&P 500 tacked on an additional 137% and rallied into the spring of 2000. As we've noted several times in these videos, charts cannot predict the future. They simply help us assess the probability of bad things happening relative to the probability of good things happening. And the probability of bad things happening is never zero, no matter how strong the trend looks or how convincing the look of the moving average is. But when you get dislocations from strong profiles, typically that's a relatively short-term event and the market goes on to make higher highs. And we've covered that topic during the correction in a February 6th, 2018 short takes post. From that post, having studied markets for years, we can confidently say the data we have in hand in 2018 on multiple time frames looks almost nothing like the data we had in hand before the plunges in 2000 and 2007. Is there anything else we can learn from these three periods? We use moving averages in these videos regularly because they're very, very visual and it's easy to illustrate basic concepts, but the CCM market model is a lot more than moving averages. It uses risk-on, risk-off ratios, it uses indicators, it uses moving averages, it uses price, and it uses asset class behavior. S&P 500 peaks right here. This is a major peak. Well before it, 1, 2, 3 months before, the growth-oriented semiconductor relative to the defensive-oriented bond ratio, risk-on versus risk-off, and this is not one of the ratios used by the model. We're using it for illustrative purposes only here. This ratio peaks well before the S&P 500, several months before, telling us that the conviction to own defensive-oriented treasury bonds was picking up. The early adopters were saying something doesn't look right here. I think I would prefer to own treasury bonds relative to growth-oriented semiconductors. This is the exact same period that we looked at before. So this is 41 calendar days after the S&P 500 peaks. This ratio is making a new low. How does the exact same ratio look today, or 41 days after the peak that we made in late January 2018? The answer is quite a bit different. Instead of peaking 1, 2, 3, 4 months ago in the bearish scenario and making a new lower low, in the bearish case, semiconductors versus treasury bonds is leading to the downside, waving yellow flags. The S&P 500 makes a new high here. We're already falling. The present day doesn't look anything like that. This ratio just printed a new all-time high before the S&P 500 has printed a new high. This is a yellow flag. From a probability perspective, this is a green flag right here. It's telling us that the odds of the S&P 500 going on to make a new all-time high are relatively favorable. It's next to impossible to make the argument that semiconductors and treasury bonds making a new all-time high in this environment is bearish or is waving yellow flags. We can learn a lot about the trends too. 41 days after the S&P 500 peaked, blue, the fastest moving average, has moved from the top, full bore bullish look somewhere back in here. Now we're down to a full bore bearish look. We have just the opposite in the present day. Instead of a full bore bearish look 41 days after the S&P 500 peaks, the ratio has a full bore bullish look with blue, the fastest moving average, on top, price above all the moving averages, and the slopes of all of the moving averages from the 50-day all the way out to the 200-day are positive. All of this, none of it predicts anything. It just helps us with probabilities. When the markets are closed and with the benefit of hindsight, the charts that we just covered appear to be relatively easy to interpret. Why is it so difficult when the market is open? Because the historical charts strip out watching the markets too closely, watching our profit and loss too closely, checking our account balances every 13 seconds, focusing on forecasts, watching financial TV, worrying about what everyone else is doing, worrying about what everyone else is saying when the futures are down 30 points after the market closes, trying to avoid volatility, always being fearful of the next pullback, always being fearful of the next bear market, always running through if and could scenarios in our head, basically having a short-term focus and short-term fear. From a psychological perspective, markets are very difficult, and none of us enjoy making any of these common missteps. Next, we'll walk through some recent news items or things that were spooking the stock market and talk about how we can use hard data and facts to try to prevent ourselves from making many of those common and easy to commit missteps. Let's talk about 3 recent news items that have spooked the stock market. Number 1, bond yields. USA Today, February 9th, 2018. Treasury bond yield spike spooks stock market bulls. It was relatively easy to find articles that said rising bond yields will usher in a bear market. Then more recently, Trump to impose sweeping steel and aluminum tariffs. March 1st, New York Times. Tariffs and a trade war will usher in a new bear market. March 6, 2018, Gary Cohn to resign as Trump advisor after dispute over tariffs. Cohn's resignation signals a watershed moment for trade and will result in a trade war. And after he resigns, the S&P 500 will flip over into a new bear market. At face value, all of these stories have some merit. So let's look at some very, very simple charts as an example to illustrate basic concepts of how hard data and the facts that we have in front of us can help us avoid those common missteps when emotions are running very, very high and the press is jumping all over scary bearish stories. This time we're using our generic and for illustrative purposes only 100-day in blue all the way out to the 290-day on the bottom of this moving average cluster. The USA Today article about Treasury bonds spooking the market occurred on February 9th, 2018. If you go back and you look at a chart of 10-year yields, yields started to break out on January 9th, 2018. So this is what the stock market's profile looked like the day yields broke out and started to rise. Obviously, we know this looks like a very strong and sustainable trend. And we also know that the stock market peaked on January 26, 2018. So by the time we get to February 9th, we've fallen quite a ways. How did this chart look after the market was spooked by bond yields? The answer is basically the same as it did on January 9th, 2018. This is the day the market was spooked. The S&P 500 dropped 3.75% in one day, or over 100 points. And when the market closed, we still looked like we had a sustainable and high conviction bullish trend. The look of this chart said the probabilities tell us that after this pullback, we will most likely see a new all-time high. And worst case scenario, we would probably see a retest of the prior highs before rolling over into a bear market. And for us, it's not specifically these moving averages. We're using these to illustrate basic concepts. But all of the data on multiple time frames tracked by the model was basically saying the same thing. Try to remain patient as long as the data allows. We're thinking in probabilities here. If you follow the markets closely, you might remember that the story on the tariffs came out during the day on March 1st, 2018. At the end of the day, was this chart morphing into this looks more concerning or an early stages of a bear market look? These are the exact same moving averages as of the close on March 1st, the day this New York Times article appeared. From a probability perspective, despite the 36-point decline in the S&P 500 or the 1.33% drop, the hard data in the model still was saying, try to be patient. The probabilities still favor higher highs coming eventually. It's not a forecast. It's just a probabilistic statement based on the facts in hand. If you've been watching these videos for a long, long time, this is not a concerning look. This is not a concerning look from a probability perspective. In fact, it's not even close to a concerning look. So we've looked at three charts. January 9th, before all of this started and the market was strong. February 8th, the day we were spooked by yields and dropped 100 points. And March 1st, the day the S&P 500 lost 1.33% or 36 points when the term tariff hit the wires. Two emotionally charged events. But if we drop the emotions and we drop the opinions and the fear, the data doesn't seem to be phased at this point. And if tariffs weren't going to take the market down, when Gary Cohn resigned, that was the beginning of Armageddon. And before we look at the next chart, it's important to note, it's quite possible that yields, tariffs, and Cohn's resignation will eventually usher in a bear market. Is that possible? Absolutely, positively, yes. But we won't anticipate that. We need to see proof of that. We're not making forecasts or predictions. We make decisions based on the facts in front of us. So, if you follow the markets closely, you know that this story came out after, this is 5:37 p.m., after the market closed on March 6th. The futures tanked. How did these moving averages look on March 7th, after one full trading day after this was announced? The answer is basically the same. There's really no appreciable mathematical difference between March 7th, March 1st, February 8th, and January 9th, 2018. All of these profiles are telling us that the primary trend appears to be healthy from a probability perspective and that the odds favor higher highs coming at some point. That could be in 3 days, 30 days, 3 months, 9 months, 13 months. But with a trend like this, it's most likely going to happen within a matter of weeks or a few months. And if it's not going to happen, and we're going to roll over, which is entirely possible, then the look of these charts will start to change, and we will be able to see that and measure it. And if we fast forward to the present day when this video was recorded, we basically have the same look. We've been saying all along that these look like high conviction, sustainable, bullish trends. It's helpful to think in extremes. This is an extreme. These are very strong trends. What does a very strong bearish trend look like with high bearish conviction in extreme? Does it look just like this? It doesn't look anything like this. This is calendar year 2002. Instead of blue, the fastest moving average being on top, blue, the fastest moving averages is on the bottom, and the slopes of all of the moving averages are down, which is basically the opposite of what we have on March 8th, 2018. This is strong bearish conviction. This is strong bullish conviction. This doesn't tell us anything about what's going to happen next. It just helps us assess probabilities. This doesn't tell us anything about what's going to happen next. It just helps us assess probabilities. As you might imagine, during the financial crisis, strong bearish conviction blew the fastest moving average on the bottom. The slopes of all of the moving averages are down. January 9th, 2018, February 8th, 2018, March 1st, 2018, March 7th, 2018, March 8th, 2018. Despite concerning events occurring and hitting the press, none of these charts really look anything like this chart or this chart. Now that we've reviewed the charts, let's loop back to the quote. The charts that we just reviewed, they're not simply lines on a page. They represent the vote of the entire marketplace. That's that net aggregate opinion of all market participants regarding all subjects, every single subject that we can think of on all time frames. And those charts, are those simple lines, will pick up unusual behavior. And by definition, anything that creates a new chart pattern is something unusual. Well, prior to the correction, we know with 100% certainty that the primary trend, the intermediate trend, the short-term trend, and the long-term trend were all bullish. After we reviewed the charts, did we see anything unusual? Did we see a new chart pattern on our time frame, which is long in this type of market? The answer is no. And when the answer is yes, it will be because we see something unusual or a material change in the data. And the only way that we can see that material change is if we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.